I'm going to turn it over to Bobby Plattenberg. She is on the line, and she also has Sean Tuttle joining her from First Command, and I'm going to hand it over to Bobby.
All right, thank you, Kate. We're going to try something a little bit different today. We're going to give out, and I'm sorry for anybody who doesn't have access to the chat box, but we're going to give out a $25 gift card to whoever poses the most questions and is the most active during the presentation today. It's a shorter presentation, so we'll have time for a lot of questions when we get to the end of it. So let's just go ahead and jump right into this. So today we're going to do 5 timeless investment principles. Investing can be complicated, but it doesn't have to be. We believe there are a handful of guiding principles that can help simplify your financial journey and keep you on track for your financial goals. For our investment principles, Principle 1 is invest in stocks for your long-term goals. Put time on your side, begin investing regularly early in life. Principle 3, invest consistently through up and downs in the market. Principle 4, stay fully invested. Trying to time the market can be expensive. Principle 5, manage risk through asset allocation and diversification. Stick into the basics. Investing can be complicated, but it doesn't have to be. True success is never guaranteed. It is often the natural consequence of consistently applying proven fundamentals. The investing principles I will share with you today are both proven and easy to apply. Investing in stocks for your long-term goals. Where should you invest your money? Speaking very generally, we believe that stocks which allow you to participate in the success of leading companies as an owner give you the best opportunity to pursue your long-term goals. Although past performance is not necessarily an indicator of future results, stocks, though more volatile, have outperformed other investments over the long run. Principle 2, put time on your side. Begin investing regularly early in life. Don't wait for the perfect moment to get started. It's kind of like having children. There will never be a perfect moment. Once you've laid the foundation by eliminating any high-interest debt and committing to investing a portion of your paycheck every month, you just have to take the plunge, even if it means starting small. Consider the case of Addie and Nathan shown on the presentation. So Nathan starts saving for his retirement at the age of 30. He begins contributing $300 a month to his employer-sponsored 401k plan. Addie, on the other hand, starts saving for retirement 5 years earlier at the age of 25. She also contributes $300 a month to an IRA for 40 years. Both investors earn an average annual return of 8%. Everybody knows when you invest, your returns are a little bit different, so maybe yours isn't exactly at 8%. But they both decide to retire at the age of 65. Addie's 5-year head start gave her a distinct advantage over Nathan, didn't it? So a $221,000 advantage, to be exact. And keep in mind that she only invested an additional $18,000 more than Nathan did. So that's 300 times 60 months to get that 18,000. One more thing. What if Addie had increased her IRA contribution by only $50 a month, but she did it for the full year? She would have added more than $1 million to her retirement nest egg. So instead of investing $300 a month, she was investing $350. You see how important it is to begin investing as early as you can and increase your investments as your income goes up. So principle 3, we want to embrace the volatility. Most people spend way too much time trying to figure out if it's a good time or a bad time to invest. There's a simple way to eliminate all of that unnecessary complexity. It's called dollar cost averaging, and its beauty in its own simplicity. By simply investing the same amount of money every month, you will be ensured of buying more shares when the prices are low and fewer shares when the prices are high. So dollar cost averaging cannot assure a profit. It's an ideal way to ensure that the average price per share that you pay will be less than the average cost per share. And if prices do raise over time, you will reap the rewards of continuing to buy through down markets. So anybody who's had a appointment with us probably remembers this chart. So this is a dollar cost averaging chart. It shows a investor investing over a period of 10 months. So in month 1, when they started investing, they bought 50 shares. So they invested $300 a month at $6 a share. And so they were able to get 50 shares. Going into month 2, they invested that same $300, but the shares were up to $8 a piece. So they were only able to buy 37.5 shares. Now in this example, they're buying mutual funds so they can purchase half shares. Month 3, the cost of the share went up to $10. They invested $300, so they're able to buy 30 shares. And it continues through month 4, 5, 6, 7, and even month 8 and 9. Now, month 8 and 9, the cost of the shares dropped to $2 each. So with that $300, they were able to buy 150 shares. So over the 10-month period, they ended up buying a total of 685 shares. They invested $3,000. The average cost of each share was $6, or the average price, I'm sorry. And then the average cost was only $4.38. So what that means is that the shares that they bought only cost them $4.38, but they're actually worth $6 now.
I wanted to jump, Bobby, if I could jump in real quick right here. Can you hear me? Yeah, so I just wanted to jump in. I mean, just kind of pulling the audience here. We obviously went through some market volatility here this year. If anyone didn't see, when the market was going down and things were not looking good, what do you think most people were thinking about? And feel free to jump in the chat and type. Losing everything, right? Thanks, Kate. Yeah, so people start to panic, right? And a lot of people's thoughts are, man, we should get out of the market, right? What if it keeps going down, and what if I miss out on, all of this money I've been working hard and saving for? And that's a natural thought. It's natural for people to think that way. But what should people actually be doing if you've got a long time horizon for retirement? What should you be doing when the market's down 20 or 30%? Buying. I heard someone chime in there, right? Buying. It seems so common sense, right? But when things are not looking good and there's a lot of uncertainty, it's always easy to say that in hindsight, right? But by having a disciplined plan, the reason we talk about dollar cost averaging is if you are systematically investing, you're automatically doing what you should be doing, which is buying less when it's overpriced and buying more when it's on sale. So I just wanted to pop in and say that we've had a really good example of what happens when you're disciplined during dollar cost averaging. And folks who are working with advisor, or folks who have a disciplined plan, tend to stay consistent and relaxed in those scenarios because they know actually it's a good buying opportunity. So thanks, Bobby.
Thanks, John. So this slide kind of goes into what Sean was talking about more. So to better understand the potential benefits of dollar cost averaging, let's compare the results of making monthly investments into a constant return portfolio to the results of making monthly investments into a so-called dollar cost averaging portfolio, which includes all of the actual price fluctuations that occurred in the S&P 500 over this time period. We chose this time period, which is 2019, or 1999 to 2009, I'm sorry. And then the reason we chose this period is because dot-com bubble happened in March of 2000. And then we had September 11th, 2001, the attacks on our own nation. We had the stock market downturn in October of 2002. And then we had the granddaddy of them all, since 1929, the famous financial crisis of 2008 and 2009. So the orange line accounts only for what is invested without any growth. The red line tracks the actual return of the S&P 500 index, but with all of the volatility stripped out. It assumes an investment of $300 every 3 months. The blue line tracks the return of the S&P 500 with its actual volatility. It assumes an investment of $300 every 3 months and includes all of the fluctuations in the index. What can we learn from this graph? The dollar cost averaging may enhance a portfolio's long-term investment results by turning scary market events and increased market volatility to your favor. Dollar cost averaging can help you tame the wild beast of volatility. So principle 4, stay fully invested. Marketing timing means making a decision to get in or out of the market based on feelings or thoughts about whether the market will go up or down in the immediate future. The problem is that it requires being right twice. Once when you get out of the market and once when you get back into the market. And no one is able to consistently do that well. Buying and selling based on emotions like fear and greed causes people to buy high and sell low, leading to the permanent destruction of assets. Has anybody had those feelings lately with the upcoming elections? Yeah, Richard, you do? I'm sure a lot of people do. But if we look at the dollar cost averaging, we know that it's best just to continue to invest, right?
I can say we're getting a lot, Bobby. We're getting a lot more calls now with people being worried about this stuff than we typically do in an election year, especially right now. Normally, the election is the biggest news in a year, and this year it's kind of been second fiddle for most of the year. There's been so many crazy things going on that everyone's a little stressed, and the market's actually back up now. But that's why that last slide is so important. Because you can see if you miss even the best 20 days, it's going to have a massive impact on your portfolio. We're talking about 9.9% vice basically breaking even just by missing those 20 days. And again, when you look at these things in hindsight, you go, man, I wish I would have invested all my money when the market was at its bottom. Why didn't I do that? Because we don't know when the market bottom is, and we don't know when it's going to go back down. In every election year, I get the same questions from both sides of the aisle. Hey, if so-and-so gets elected, everything's going to fall apart. I think I should park everything in cash. Well, if you would have done that over the last few elections, regardless of who won, you'd be in really bad shape. You would have missed out on a lot of potential upsides, even if there was some volatility. So it's one of those things that you see it on the news. It's a lot. You can keep people tuned into your television station by kind of keeping them nervous and scared. But if you make that decision in the long run, if you're a disciplined long-term investor, it can have really bad negative consequences. So you just gotta. This is a really important chart to keep you calm in that situation and stay on track. Thanks.
Amazon is great for that example. Yeah, Richard, that's perfect. Principle 5, managing a portfolio risk. So we call this a quilting chart. Look at the different asset classes. Each year there are winners and losers, but there is no consistency to the pattern. Even so-called investment experts really don't know which asset class will perform the best, the worst, going from year to year. And let's highlight the range of the assets located in the portfolio. You can see that the highlighted area eliminates some of the wide swing turns of certain asset classes. So this actually isn't letting me highlight the different sections, but we'll try to talk through it. And Sean, if you want to help with what should be highlighted, that would be great. So now let's look at the emerging market stocks. So the emerging market stocks are developed market foreign stocks. There are also and then there's treasury bills, cash to observe the volatility of outcome. Just look at the wild ups and downs. So each colored line in this chart is supposed to show a different graphic, and if you can read the letters on it, it tells you which one is which. I have a really bad picture on my screen, but I think the blue is the cash positions. So you can see how the cash positions appear to have a more conservative position, but even when it gets to the 2018 portion, it's still pretty volatile. The white is the foreign stocks. No, is the regular stocks, and then the orange is the foreign stock. So no matter what you invest with, there's always that risk that's associated with it. So what's an investor supposed to do? In a word, diversify. By spreading your money across several different types of investments, you can ensure that you will always have some of your money invested in the best performing asset classes over a year. And just as importantly, that you will never have all of your money invested in the worst performing asset classes. The white squares represent the kind of diversified portfolio I'm talking about. As you can see, this approach makes for a much smoother ride.
Cynthia brought up a really good point in the chat too. I didn't hear if you said that, but it depends on if you have time to wait it out, and that's really important. Diversifying is always very important, right? Because we can't predict what the best sector is going to be. But when people say, what's the best portfolio? What are the best investments for me? Well, it really depends on your time horizon for that money, right? If you have money that you need in the next year, it probably shouldn't be in the stock market right now, right? If it's sitting in the stock market, there could be volatility. We don't know that for sure, but there could be a massive change in the price, and now you might be able to not to accomplish that goal because of that volatility in the short run. But if the goal is 20 years away, you have plenty of time to ride out some of these market cycles in dollar cost average and be okay. Most folks, though, when you pop on the TV, you're wanting them to tell you, hey, what should I be invested in? Well, emerging market stocks in 2009 did 78%. If someone told you that's what you should put all your money in 2009, what would have happened? Well, in 2010 and 2011, they were down 19%. And so then what you would do is say, okay, well, actually, that was a bad call. I turned on the wrong channel. I need to watch somebody else. And they told me to go buy, the next hot thing. So you're selling out when the market's down and you're buying back when the market's high. And doing that over time really causes some issues. So I just want to bring up, that's a great point, Cynthia. It really depends on when you need the money.
So summing it up, told you this was a short one. So invest in stocks for your long-term goals. Put time on your side. Begin investing regularly early in life. Invest consistently through ups and downs in the market. Stay fully invested. Trying to time the market can be expensive. Manage risk through asset allocation and diversification. We have another question in here. When you mention selling, do you mean moving to a different fund? So ideally, yes. It can be either selling to cash out, or it can mean selling one fund to move to a different fund.
Yeah, when we say sell, it means closing out one position and jumping into another one. And when we looked at that last slide, you can really see by trying to time that and selling one and buying the other, that's when you can really put yourself into a bad position. But the other side of that is selling out completely, right? So there's two things. You could sell and move to another asset class. You could move from stocks to bonds, but you could also sell everything and pull the money out and put it in your bank, right? That's moving to cash, to a different asset class. That's where you really can hurt yourself. So changing your risk tolerance is very different than completely pulling your money out of the market. And I've encouraged that when people are stressed and they can't handle the volatility. It's not a great time to do it, but I'd much rather you move into something more conservative than completely divest and get out of the market. Great question.
Does anybody else have any questions?
This is Kate. Richard just asked, where can we see these charts? And for those of you who didn't hear me at the beginning, we will be posting these presentations on the MWR website. So you can see them in their entirety for people who have been unable to attend the whole session. And I will put the link in the box. And those are for you to watch at your leisure in the future. Hope that helps.
Thanks, Kate. We've got time. This is a relatively quick presentation. We have time to open up for questions about the presentation, but also really, we're kind of the federal employee experts. That's how we categorize ourselves, and we work almost specifically with federal employees and military. So we really understand these benefits. If you have specific questions on your benefits or something in the presentation, we wanted to make sure there's plenty of time to open that up to you guys right now. You can use the chat, or if you, I think I heard someone chime in at one point as well. Feel free to jump in right now, and we'll leave some space for folks to ask questions. I wanted to mention something kind of tied to one of those questions too on that time horizon one, really a comment. Part of what we do, and Bobby explained it a little bit, we kind of help demystify the federal benefits that you have, right? A lot of times people give you a big stack of paperwork when you first walk in. And if you're like most people, you set it to the side and go, yeah, I'm going to find some rainy weekend and really learn about TSP and just really dig deep. And then what happens is, like most people, you don't get around to it because it's not that fun. One thing that we do is a no-cost analysis of those benefits, which includes just, hey, what do I do with my TSP? It doesn't cost anything, but I wanted to jump on that comment. If you are 32 and you've got 35 years before you retire, you probably don't want to be in the G fund. I don't know that for sure, but you probably don't want to be there because it's very conservative. You generally aren't going to have the same returns over a long period of time that you would if you put the money into one of the other opportunities. So one of the things we do is just take a look at that for you, walk through and say, hey, based on what you're trying to accomplish, you probably want to adjust this TSP. And a lot of times that helps folks because about 70% of people end up in that G fund because it's the default fund. So just wanted to put that out there and want to give some time. If anyone has any questions and wants to jump in, I want to leave some time for that too.
So nobody's going to ask any questions. I've got a question. Who knows the funds inside the TSP that are actual stock funds? Yeah, so the CS and I are the stock funds, and then the G and the F are the bond funds within the TSP. Are you asking about the more aggressive funds versus the conservative funds just within the thrift savings plan, or overall investment? Okay, so if you go to tsp.gov, they actually had, I found it this morning, a really nice breakdown. So according to, yes, the life cycle funds do too. According to the tsp.gov website, they are classifying the C fund as a moderate fund, the S fund as a moderately high fund, which would be moderately aggressive, and then the international fund, the I fund, as a aggressive fund, a high risk fund. It's got the G fund being listed as a low, which would be a more conservative, and then the F fund as the lower moderate, which would be a moderately conservative account.
Which is really interesting because the C fund basically tracks the S&P 500, which was 100% equities, larger companies, but still almost 100% equity position. And if you came in as a client and you had 100% stocks in your portfolio, I certainly wouldn't categorize you as a moderate aggressor, or excuse me, moderate investor at that point. That's a pretty aggressive position. So important to know that. Lori brought up the L funds. The L funds are a combination of all the TSP funds, and they're built in a way that they get more conservative as you get closer to your target date. It's a really nice opportunity if you're just trying to get some basic retirement planning and basic allocation set up, but it gets very conservative once you get to that target date. So I don't know, Bobby, if you're planning on talking through the different funds at all, but they're a really important thing to know about.
Yeah, I was going to leave that kind of up to questions and then try to tie the TSP to the presentation we just did.
Sure.
The nice thing about the life cycle funds is that they're diversified for you. Something to remember, though, is that when you're dealing with these life cycle funds, it's not so much your planned retirement date that you want to select for the year group. It's the date that you actually plan to begin withdrawals out of the TSP. So if you're going to retire at 56, but you're going to pick up a part-time job and not use the money for 10 more years, then you're going to want to choose a life cycle date 10 years after when you plan on beginning the withdrawal from the account.
That's a very important point. By the time that number hits, let's say, and just to clarify, the life cycle, that L2040 fund, 2040 represents the year you plan to start using those funds, like Bobby just said, right? Those numbers correspond with a date in time, right? 20 years from now. What will happen is the 2040 fund in the year 2040 is going to be like 80% G fund, basically in a nice money market type account with very little exposure. And I think one of the questions that Richard was asking, is there a combination between the two? I just pulled up some returns. The G fund average return over the last 10 years. Does anyone want to venture a guess to what it averaged over the last 10 years per year? Bingo. Christy, do you have the website pulled up? 2.07%. So you were very close there. Spot on. What about the C fund? What would you guess without? Okay, good job, Christy. Without cheating, what would you think that the C fund has done over the last 10 years? Christy, 7%. Anybody else? 10%. Actually, 13.62% per year over the last 10 years is what it's done. So pretty darn good in the C fund. Now, if we were to set a chart side by side with compound growth and show one return getting 2.07 and one getting 13.62, that difference would be vast. That's the difference between retiring when you want to retire possibly and working a couple more years. That's the whole point, is you're not needing to look in market time. And over that period of time, guess what? In March, if you had to pick right before the market dipped, you probably would have said, man, I would have rather been in G fund. But even with that huge dip, what would you guess year to date is the top performing fund in TSP? Bingo, the S fund. It's 9% year to date. What has the G fund done? 0.8%. Now that doesn't mean that one fund is good or one is bad. I'm not recommending, we already learned that you put everything into the S fund because it did the best this year, because there's certainly been times where it didn't do the best. And in fact, over 10 years, the C fund has done better than the S fund. So that's really point number 5 coming through hard. You want to make sure you've got a nice diversified portfolio. And if you just do that and kind of drown out some of the noise and invest consistently, you don't have to worry about all that extra stuff of changing the portfolio. 13.62 is pretty gosh darn good. And since inception, it's done 10.5% in the C fund. So wanted to throw that in there. great discussion. Any other questions from the group here? Anything you have questions about with TSP or benefits in general? Looks like a couple people are typing, so I'll be quiet for a second. Yeah, Chrissy, I see. The nice thing is it shows me that when people are typing, so. Okay. So it sounds like Richard's saying the L fund still has me somewhat confused. So Chrissy, while you're typing, we'll jump on this one. The L stands for life cycle. And currently there's the L income fund, the L 2030 fund, the L 2040 fund, and the L 2050 fund. What happens is the L 2050 right now would be pretty gosh darn aggressive, right? Because we're 30 years out from that time horizon. This question is, when does it start becoming more conservative? Those portfolios are consistently shifting, and I don't know if it's rebalanced daily or monthly, but you can actually get in the TSP website, and there's a side scroller that shows you, if I'm in the L 2050, what is it going to look like in 2030 or 2040? And it continuously is morphing into a more conservative portfolio over time. The only thing I don't know is how often that's occurring within that portfolio with the rebalancing. I'm sure that'd be an easy thing to look up. But what happens is basically it's shifting. 2050 in 10 years is going to look a lot like what 2040 looks like right now. And then it's going to look like what 2030 looks like. And then in the year 2050, it's going to look like the L income fund. It's going to morph over that period of time into the income fund, which is almost entirely in the G fund, right? I can't remember 70% or 80 some odd percent. So the point Bobby was making is, unless you're planning on spending most of that money within 10 years of 2050, you probably don't want to have all your money sitting in something that has earned, less than half, significantly less than half over a long period of time than what the C fund has earned. Does that kind of answer your question, Richard?
So right now, if you look at the retirement fund for L 2020, that fund is kind of set up for people who are retiring between 2019, so already did retire, up until about 2024. And it's got about 75% bonds, and so about 25% stock right now. And then if we look at the L30 or 2035 fund, which would be retiring in about 13 to 15 years, it's your group's 2033 to 2037. And that one's currently about 33% stock, bonds. And so about, 67% stock then? And that's just the 13-year difference between the two.
Yeah, so the point she's making is it is changing at not a rapid rate necessarily, but it's moving pretty quick and getting conservative relatively quickly. And Lori brought up a point too. Like I'd mentioned before, you can get on there and actually see year over year what it looks like. As Cynthia said, so if you have your money in the L fund and it's mostly G, can you redistribute it to have it at least 20% in C fund to gain some income in retirement? Bob, you want to take that one?
Yeah, so within the thrift savings plan, before you move 20% into C, if you are using a life cycle, I would pull up your account and see how much the life cycle fund is contributing to the C fund for you. But you do still have the availability to allocate a certain percentage of your contributions to go into the individual funds, along with utilizing one of the life cycle funds. So if you wanted to be just a little more aggressive, you could go and set that, 1% of every contribution goes into that C fund to build it up a little bit more. That's one of those things that, we'd want to sit down and go over your risk tolerance and kind of see if that's necessary or not. Does that answer your question, Cynthia?
That's absolutely right. Yeah. So So you always you don't have to use a life cycle fund. You can use any combination you want to. But again, that's really where there's some value in just having someone take a look, right? What's your particular situation? One is there's a subjective side of risk tolerance and an objective side. Part of it is if the market goes down 30%, what type of phone call am I getting? If you were a client, what type of phone call am I getting the next day? Is it I haven't slept at all and I need to pull all my money out? Or it's, hey, look, what a great buying opportunity. That's one big factor. And then the other factor is when are you going to use the funds, right? And we kind of do an analysis and take both of those into consideration to say, for you, this is the correct mix to try and maximize your potential return and minimize the risk of you saying, I need to get out of this thing and selling when the market's down. We saw the impact of what that can do.
Christy's got a really good question.
Yeah, take it away, Bobby.
So Christy asks, for IRAs, do we have to go into our accounts often to reallocate money that we deposit? The short, quick answer to that is possibly. And as you get more money in there, that answer is going to become more of a yes. And so it goes, if I deposit $500 and pick 4 stock funds and buy 20 shares total, next month I add another 500 deposit. Do I buy more shares or does that get distributed to my 4 selected stock? It can do both. It's not a direct question. Well, it is a direct question, but it's not really. In the TSP, you can select and you can change as much and often and easily as you want just by logging in. Most advisors, if you sit down with an actual financial advisor, I know me personally, if I see that you have $500 that we're going to invest on a regular basis, I'm going to start you out with a more advanced portfolio, which is probably going to consist of 4 or 5 mutual funds. That 4 or 5 mutual funds should be pretty well diversified up until, I'm going to say, probably $100,000, $150,000 into that total investment. Now, everybody's a little bit different, and it's going to change as your risk tolerance changes also. But if it's in an IRA, we can move it around. We can move the money around to different shares to make it more conservative or more aggressive, depending on how you feel. I mean, we're not going to do it daily or monthly or anything, but we can change how we're contributing to keep the portfolio balanced. And there's no tax consequences within an IRA for moving it around and keeping your portfolio balanced so it fits your risk tolerance. If you're going to only do like $100 a month, we normally suggest starting out with just 1 mutual fund. And then as we get up to $5,000, we might add in a second mutual fund. As we get up to $25,000, we might add in a third. And every advisor and every person is a little bit different, and we all have our different balances where we add in that extra fund to help build a better, more well-rounded portfolio.
Perfect. Yeah, and so it really, I mean, part of that answer is it depends on if you're doing it on your own, in what system you're investing in. If you're working with an advisor and we want to keep you balanced, then that's something that the advisor could do actively. If you're doing it on your own, it might kind of depend there, but great answer, Bobby, as well. Cynthia asked about, do you recommend a yearly review with a financial advisor regarding portfolio or more frequent meetings? And Hunter jumped in there. The portfolio is the thing people are most excited about and really want to talk about and sit down and look at. I'm not saying it's not important. It is very important. But generally, when we get into a good allocation and we're set up for long-term goals, it's not something that we're really going to tweak and change on a regular basis because, again, when we look at it, as long as we're well diversified, neither you nor I know what the next hot thing to buy is. And the more you try to guess that, the worse it tends to be. But the reason you meet with an advisor on a regular basis is once you've created a plan, which is the most important part, right? Putting a comprehensive plan together that makes sure you know where you're going to and how to get there. You probably want to review it at least once or twice a year because your life is going to change. Generally, probably every 5 or 6 months, there will be a decent sized change you need to account for. Okay, and that might be a change of a job, a change of your spouse's job, the kids getting ready to go to college, you're purchasing a home. These things come up all the time, and it could dramatically change your plan. And if we don't go in and account for it or account for new goals that come up, you're going to end up just kind of arriving at that situation and trying to figure it out last second. And when that happens, Sometimes people will not be prepared and use a credit card or pull money out of their investments or do something that could really impact their plan negatively. So a lot of what we do as advisors are making sure that we're on track for our plan, and the portfolio is part of that, but the behavior side is much more important. And you have a coach or someone to kind of keep you on track with those things. We see a much higher level of success with people doing that than we do if you're completely doing it on your own. Not to say you can't do it on your own. Does that make sense?
And also, by meeting with your advisor yearly or even every 6 months, it helps build the relationship so that we can better know your needs and your tolerances. So that, like right now, it's volatile. I know which clients I need to call and have a good conversation with. And it will help build that relationship so you feel more confident about the advice we're trying to give you. Then we have TSP has 2 ways to update: regular percent allocations per pay period, to rebalance, do an interfund transfer based on diversification goals. Is that a question or a statement there, Lori? If we're looking at rebalancing, we probably don't have to rebalance the entire thrift savings plan. It could be something as simple as just reallocating your next few contributions or something to help balance it out. But I do think they offer the selection in the TSP website to do a complete rebalance if you wanted to, yeah.
Yeah, and I think what Lori's saying too is you can change your contributions. There's 2 tabs. One is to change what you're putting your monthly contribution into, and one is to change what the current allocation is. And that's a really good point, Lori, and I think you might be our resident TSP.gov expert. It's good to know that. Sometimes folks will go in thinking they reallocated their portfolio. They were all in G fund and they think they went in there and moved everything into C fund, but what they really did is just change their future contributions. And so all of a sudden, 6 months later, they go back and say, man, I probably did great with this up market because I'm in C fund. And they just go back and look and see that, yeah, 10% of their pay has been going into the C fund per month. But they didn't actually move their existing allocation, what things were already invested in, into the C. So that's a really good point. Any other questions for the users on the phone? Anything? These are fantastic questions, great discussions, kind of what we were hoping for, that you would have some good topics here. But anything else that you guys have questions on in general? And if you're on your phone and you can chime in or message, please don't be shy. Christy asked, do your advisors start with a consultation or jump right in? So there is a no-cost consultation where we're going to go through and just touch base and kind of figure out what's going on and what questions you have. I don't want to speak entirely for Bobby. I'll give her a second to comment too. But if you just have a few questions and want to set up a time to chat on the phone, we're more than happy to do that. Our number one goal is to provide value, answer questions that you have, and then they'll walk you through what the process would be to move through those steps if you wanted to put together a comprehensive plan that ties in everything as opposed to maybe just TSP or federal benefits. So we've been doing those via Zoom, so it's pretty easy to jump in. All you do is shoot an email to Bobby and Hunter, and they will schedule you that initial consultation via Zoom. If you decide, hey, look, this seems like a great idea, I want this information, they will tell you what information they need to receive securely to start moving down that path. The plan is yours, the information, the data is yours. You can implement those recommendations that we make with us, or if it's just stuff within the federal government, there's no cost to doing that. We get compensated based off of if you implement some of those recommendations, depending on what it is. The advisors are compensated through that. Bobby, does that answer on your end there for how you're doing those?
Yeah, for the most part. Just the big thing is let us know at the beginning if you're just looking for a few questions to be answered, and we can keep it to just answering your thrift savings plan or your FERS questions and stuff. Just kind of give us, hey, I'm already working with somebody. I just needed somebody to specialize in this sector or whatever. Other than that, we can't give advice if we don't know your situation. So depending on how you classify a consultation, we still need to know what your LES, what your pay period stuff looks like. We still need to know your annual salary and stuff. We're still going to ask you some risk tolerance questions because we can't give you advice on how to adjust your thrift savings plan if we don't know what you can tolerate within an investment. And so there's the basic stuff that we just have to know to be able to really help your situation. I like to build a plan for everybody and kind of give you an ideal of where you're sitting with your goals. We have some really neat planning software that I just really enjoy playing with. And so I always like to sit down and go over that. And with that being on Zoom, you can see exactly what we're inputting to get an idea of where you're sitting. If that's all you're looking for, that's perfectly fine. It gives us the peace of mind that you're headed in the right direction. If you want to move forward with some of the recommendations that we mentioned and stuff, let us know that too, and we'll move on to the next step then. So it can be done in one step with just questions, or it can be a full 3-step process where you actually become a client and we form a relationship together.
Perfect. And I was just going to add to that, something a lot of people see value in is tying in maybe a spouse or significant other's information into their plan, because someone goes, what do I need to retire? I'm putting 10% of my TSP. Am I in good shape? Well, shoot, that's a really good start. I can tell you that you're doing more than most if you're doing that. However, if your spouse has no retirement savings, or if your spouse is really killing it on the retirement savings front, or you have a whole bunch of credit card debt, all those things dramatically change the answer. So we are more than happy to help and add value if you have simple questions. But to Bobby's point, it's all interwoven. And so the more data we can get, the more we can help. But again, we will help in any way that we can. Our number one goal is to point you in the right direction.
And keep in mind, with bringing in the spouse, we don't just work with a thrift savings plan. We work with all outside investments. And so if you have somebody that works at a different location, we can take a look at their employer-sponsored plan, making sure that you're doing the most for the matching and taking the, getting the most out of your money and your investment with their plan also. Is there any more questions from anyone? I kind of think the most interactive person was Richard Prue. We posted our email information a couple of times. If you want to send us an email with your address, we'll get that gift card out to you.
Okay. Well, thank you, Sean and Bobby, and also Hunter, for your help in clearing up a lot of the information and more that you had in the presentation. It's always great. And we look forward to presenting more for DLA and Battle Creek in the future.
And just one other thing, if you would let Kate know, number one, how we did, and also if there's other topics you guys really want information on, that's always very helpful to us. Our number one goal is that this is productive for you guys and you're getting the information you want. So appreciate it, everybody. Thanks again.
Thank you, everybody, for joining us. We look forward to more presentations in the future. If there's anything you would like to see, email me directly. Again, this is Kate from MWR, and my email is mwrbattlecreek@dla.mil. Thanks, and have a great day, everyone.